So you interview investors from A. Andreessen to Z. Zell in your book. But before we talk about your investors, let's talk a little bit about yourself. How did a humble kid from Baltimore end up here among the bright lights of Wall Street?
It was fortuitous. I was a lawyer. I practiced law in New York. I went to Washington to work in the government. I worked in the White House for Jimmy Carter, got inflation to 19%. We didn't get reelected. Had to go back and practice law. Wasn't very good at it. So in 1987, I said, I'll start an investment firm in Washington, and it grew to be one of the larger private equity firms in the world.
What about private equity suits you in particular? Because you interview a lot of different types of investors in your book, but you're in private equity.
Private equity is a business I've been in for 35 years, but I obviously know something about other areas of investment because I've touched on them in private equity. But I do a lot of interviewing these days, and I get to know a lot of people, and therefore it wasn't that hard to get these interviews.
So Carlyle is well known as a Washington firm, very well connected. Can you talk about the connection between Washington and Wall Street and access?
Well, sure. When I started the firm, people didn't pay attention to it because it was in Washington. It should have been in New York, people would say, if you're going to be in private equity. I subsequently brought in a lot of former government people like Jim Baker or George Herbert Walker Bush, and that conveyed the idea that we were well connected in Washington, and we reasonably were, but we really don't do lobbying, so being well connected in Washington doesn't mean that much for our business. Everything is the rate of return, and our rate of return turned out to be okay, so the business kept growing. And we did one thing that changed the face of private equity. We had many different funds at the same time. Historically, private equity firms had one fund. After 4 years, they'd raise another one. We had many different funds in different areas, and we therefore institutionalized the business, and then we globalized it.
Private equity is currently a place where a lot of folks are making huge fortunes, and fortunes come and go on Wall Street. Some areas are hot, like crypto, not as much right now, or SPACs, not as much right now. And you write about those areas in the book. Do you think that private equity will remain hot?
Private equity has been dismissed as not likely to be continually successful for 40-some years. And for every couple of years, people say, well, it can't get any better, but it gets bigger and bigger. And that's because the rates of return have been better than any of the things you can do with your money legally. So I don't think it's going away. The rates of return may come down, but the gap between public equity returns and private equity returns, I think, will still be 300 to 500 basis points, enough to kind of keep people interested in private equity.
Well, outside of private equity, you speak with a lot of well-known hedge fund managers like Stan Druckenmiller, Ray Dalio, John Paulson. So what makes for a good hedge fund manager, according to the conversations you had in the book?
A good hedge fund manager is somebody who, when he or she, but more typically it's he's, when they make a decision and they go wrong, they get out of it quickly enough. In other words, in life, I often say I made a right decision here, and when I turn out to be wrong, I don't like to admit it right away. But a really good hedge fund person gets out of that position and says, okay, that was a mistake, and I go on to the next thing. And that's what a really good manager does. Recognize that the market may not really accept your brilliance and get out of that position and go on to something else.
You also interviewed the notoriously secretive Jim Simons. Now, he uses math to beat the market, and he doesn't really give out his secret. Can you talk about how the quants have really taken over Wall Street and replaced a lot of the gunslingers like Michael Steinhardt of a different generation?
Well, Jim Simons is one of the first, if not the first real, I would say, quant. He built Renaissance into a great fund. Renaissance Medallion Fund became maybe the most successful of all the funds over the last 30 years or so, but it's not available to everybody. It's just for the employees there. He's a very smart mathematician. He was a world-class mathematician, but he doesn't give out his secrets because that's not his style. And I think other people have followed him and done reasonably well, but you have to really know what you're doing.
A lot of folks say that the game is rigged in favor of these hedge fund managers. And then last year, we saw the meme stock uprising. Can you characterize that and how stocks like GameStop went up because a lot of smaller investors saw what's going on in the hedge funds and they took it to them?
Well, the meme stock phenomenon has probably come and gone. It may happen again, but generally what happened there is when you short a stock, which is what happened there, you can really get burned. And a lot of people shorted stocks, and all of a sudden the people came in and bought these stocks, and the shorts had to cover their position, and they lost a lot of money. But I don't think that phenomenon is going to continue very much.
But do you think it was a comeuppance for some of the hedge fund managers?
I don't notice any of the hedge fund managers going to subways, actually. I think they're doing okay.
Well, a lot of the crypto investors might. And let's talk about the cutting edge investments, which you describe in your book. You speak to Mike Novogratz for one of them. So what did you learn from Mike Novogratz?
Mike is a former Goldman Sachs trader. He was one of the people that helped start Fortress. He then built his own digital company. He had, at the time I interviewed him, I don't know, $8 or $9 billion of Bitcoin, something like that, I suspect. I don't know exactly what the number was. Obviously, it's gone down in value today, but he's a big believer in trying different things, and he's a big believer in these kind of cryptocurrencies. So I would say he probably is less ebullient about crypto than he might have been, but I don't think he's dismissing it as something that's in the past. I think he's still a big believer in it.
You spoke about SPACs with Betsy Cohen. Can you talk a little bit more about sort of almost faddish type investments? Because a lot of them are here today, gone tomorrow, and a lot of the smaller investors are left holding the bag with a lot of resentment at the system.
When advertisers want to get something to be bought, what do they use as the most commonly attractive word? It's new. People like something new. People don't like old. So when a new phenomenon comes along in the investment world, people want to try it. They say it's new, and they see sometimes the value is going up, so they rush into it. And sometimes they rush into things that might not really sustain themselves over a period of time. SPACs are a good example of that. I have a chapter in the book on it. SPACs for a while were the hottest thing on Wall Street. Now probably 95% of the SPACs are under the value that they were when they went public. And that's because in the end, I think people lost interest in the SPACs and they thought companies weren't as good as people had thought they would be. But there always will be a new phenomenon. Do the small guys get left holding the bag? In life, generally, the small guys often get holding the bag, not just in the investor world. There's no doubt that life isn't always fair, and sometimes the small investor doesn't get the information on time. But if you read and you know what you're doing and do the research, you won't be left holding the bag.
But the question is, are the hedge fund managers getting the information early as opposed to the small investors getting it late?
Early and illegal are two different things. I don't think they're getting it illegally, but I think they are better. They do better research. They're very much on top of what's going on in various companies, and they do a lot of research. They get a lot of information. The average person who's a doctor or dentist, he or she is not spending time getting all this information, so they're going to be not as knowledgeable as the hedge fund people. The hedge fund people what are they? They're just smart guys who are trading and basically looking to kind of get an advantage. Sometimes they do well, and sometimes they go out of business. Remember, most hedge funds go out of business. The ones we talked about in this book are the ones that have been around for a long time, but that's the rare exception.
Well, Warren Buffett has famously challenged hedge funds. He said, give me an index fund instead. How do you reconcile Warren Buffett, who you don't interview for the book, and a lot of the folks that you've spoken to?
I've dedicated the book to Warren Buffett. I've interviewed him before. I've interviewed him in my leadership book, so I didn't put another interview in here with him. Warren Buffett is a very smart person. He's saying, on average, an index fund, stock index fund, will outperform hedge funds. That might be true, but most people think that they're going to pick the hedge fund that outperforms the market averages. And there are always going to be some hedge funds every year that dramatically outperform the market averages. The trick is to know which ones there are. But if you're just going to pick the average hedge fund index, you might not beat the stock market index, but all investors think they're always going to be smart enough to pick the best hedge funds.
Another acronym which is getting a lot of play these days is ESG. You speak to Larry Fink. Now, one would think it would be a good thing to do well for the environment and do well for your own pocketbook. What's your stance on ESG?
Well, ESG is getting beaten up a little bit. ESG, for those who haven't followed it, basically means environmental, social, and governance. And the theory is that if you employ these environmental, social, and governance indexes and you worry about that in a company you invest in, you'll ultimately do better. Now, some people would say, actually, you'll do worse because you're going to be not focused on profit as much as ESG. Right now, ESG is getting beaten up a little bit because people think that the market has tilted too much towards ESG and not enough on profitability. And there are different sides of that. But I think in the end, ESG is not going away. It just might not be as much in the forefront as it was maybe a year or so ago.
Electric cars are a favorite for ESG investors. You have a great conversation with Ron Barron in the book. Ron Barron has famously almost bet the house on Elon Musk. Right now, that house is a little bit shakier than it was. So what's your view on investing in a genius as opposed to a stock?
Well, remember, there are a lot of geniuses who built great companies, and Microsoft was built by a brilliant person. Apple was built by a brilliant person. I think you could argue Facebook was built by a brilliant person, and same with Google. So if you follow smart people, you're generally going to do reasonably well. Sometimes they get out of control and they make mistakes. I think the thing is, make sure you know what you're doing. Read. Make sure you've done the research, and don't just follow what your neighbor tells you to do. Make sure you've read things. That's the most important thing you can do, is read and make sure you know what the facts are, what the fees are, what the risks are.
So Elon Musk is now getting into Twitter, which is away from his manufacturing history. In the book, you talk to Sam Zell, who famously topped the real estate market with a sale to equity office property. But he had a little bit more trouble in the publishing business with the Chicago Tribune. Can you talk about perhaps the hubris of some of these investors? They say, you know something, I know this, and then they fail at something else?
Well, for those who don't know, Sam Zell built the most successful real estate office company in the United States, EOP. He sold it at the absolute top of the market to Blackstone. Blackstone, thinking it was the top of the market, pre-sold 3/4 of it to other people. Those people didn't do so well. Blackstone did quite well. The profits that Sam Zell made above what he was prepared to sell the company for, it was an auction, so he got a higher price than he was prepared to sell it for. He took those profits, in effect, and invested it in the Chicago Tribune. So you could say he was playing with the house's money because he didn't really expect to have that. Tribune didn't work out. It went bankrupt. The ESOP structure didn't really work. But I saw Sam earlier today, and he's not worried about it. He's on to the next thing. He's done quite well.
And then finally, another great investor, the late, great Jack Bogle, developed the index fund. I could only imagine what he might say about some of the investors in this book and the way they invest. I don't know if you've spoken to him in the past. I have. It was a wonderful conversation. If he were to write the foreword for this book, what do you think he would say?
Well, he would say that basically you should pay very, very modest fees for anything. So paying the hedge fund fees or private equity fees, he would say, is a mistake. He built Vanguard into one of the great investment companies in the world, a great investor. But he was not a person who was interested in picking particular stocks the way that some of the hedge fund guys are, or spotting trends the way some of the hedge fund guys are. So he was a different kettle of fish, but he did very well. And the people that invested in Vanguard have done quite well.
Thanks a lot for taking the time.
My pleasure.